Hello, everyone, and thank you very much for joining us for the Nasdaq Dorsey Wright podcast for this Monday, November 29th. My name is Ian Saunders, and joining us here as well as Will Gibson. And Will, we're coming into the last podcast for the month of November. Wrapping up. Last week, we wrapped up a shortened trading week, but a week that was certainly full of quite a few notable market events that we're going to dive into here in just a sec. But I hope that everyone joining us had a wonderful Thanksgiving, maybe got some time to spend some longer time with some family or some friends, and certainly diving back into things this week with some amplified market movement. So even though we got a shortened trading day on Friday, markets were only open until 1 p.m. Eastern time. They certainly took advantage of that in that short time that they were open, as we got some news from a new coronavirus strain, the Omicron, I believe if I'm pronouncing that correctly, strain that was announced there with early in the morning of Friday, I believe, led to some pretty significant downside participation for most of the major domestic equity indices. So diving in first and looking at some of the performance of those indices, we saw all of the really kind of major domestic equity indices down in excess of 2%. The small caps really got beat up really bad, with the Russell 2000 index posting a loss of over 3.6% just for the day on Friday. That does now bring the trailing 30-day performance for the Russell 2000 into the red at about a 0.3% loss over the past 30 days. So we'll see where things shake out as we get through the rest of the trading here over the next couple days to wrap up the month of November. But the Dow, the Nasdaq composite, and the S&P 500 all posted losses in excess of 2%. So pretty big down day for most of the major domestic equity indices, and that led to some downwards movement for some of the main participation indicators that we track here at Nasdaq Dorsey Wright. So for those following along on the website, you can go to the technical indicators reports page to take a look at some of the different percentile-based indicators that we have that measure, okay, we understand that markets may be moving higher or maybe moving lower, but how many stocks are participating in those moves, right? How many stocks are participating in those moves to the downside? How many names are moving to sell signals, even though the broader indices are down a couple percent? And we did see several of those major participation bullish percent indicators back off, indicating that a lot of names were moving to sell signals. Most notably, perhaps, to look at initially would be that bullish percent for OTC, the bullish percent for the Nasdaq OTC market, which did decline to a chart level of 38%, the kind of the lowest of those major ones. So only 38% of the stocks in that inventory there are going to be on a current point and figure buy signal. That's the lowest participation reading that we've seen for that inventory actually going back until April of 2020. We saw some of the participation there back off a little bit more earlier in the week and then really amplified there in trading on Friday. We did see as well the bullish percent for the NYSE, BP NYSE, did back off as well, but is not quite at lows for the year. It's sitting there at a chart level of 52%. If it gets down to a chart level beneath the 50% threshold, that would mark a new 52-week low for that particular indicator, but nonetheless, maintaining at that level above the 50% threshold, at least currently. We are seeing, even though markets are rallying a little bit at the time of this recording on Monday, these participation indicators are still kind of backing off on an intraday basis. So these are definitely going to be a pretty important place to monitor, really provide some better perspective on where things sit underneath the hood of some of these major indices. But nonetheless, well, certainly no shortage of movement to talk around these major indices, given the continued kind of lack of participation, given the technical setup that we have as we enter into the last month of the year. We felt it would be pretty prudent to take a look at some of these major domestic equity indices and take a look from a technical perspective, just where things sit, where some near-term support is, where some potential overhead resistance might be as we move through the final month of the year here, Will.
Yeah, Ian, absolutely. And I think we'll start today with the dinner ticker these days, the S&P 500, pretty commonplace discussion as it feels. And looking at this chart, you can do so on a variety of sensitivity scales, and they're often very sensitive. Right now, you're seeing sharp reactions to news events. And the S&P 500, we like to look at this chart at a 20-point scale, and we believe this gives us an appropriate picture of that supply and demand battle going on for the major index. And looking at that 20-point scale, we see a reversal intraday up to about 46.60, and with that reversal higher, that gives us a new level of longer-term support to work from, located at around 4,600 now. So that is a positive movement that we're seeing intraday as markets are rebounding. Now, something that I would caution here, and this is going to lead into a more kind of qualitative statement, is that should we reverse back down, give a second consecutive sell signal, that could be a point of near-term concern. Ian mentioned before that you are seeing some still weak participation on the day despite the market rallying. You're seeing those intraday bullish percents continue back off their levels. So a second consecutive sell signal on the S&P will come at 45.80. We are not at that today. Of course, we did get that reversal higher. So right now, near-term picture is still improving and positive as we have that 4,600 level to work from. Another way to look at this, if you wanted to look at it a bit more sensitive, you could look at it at a 10-point scale. So it's going to be moving a bit quicker than your 20-point. We do have two consecutive sell signals on this 10-point chart. Support also around 4,600, 4,590 to be specific there. So we like to see those two sensitive and longer-term scales confirming one another, those areas of support aligning. That can give us some more technical confidence when we're looking at the chart there. Then more of a qualitative comment on scaling here. You can manipulate these charts to get them to show you what you want, but that's not going to be helpful at the end of the day. We want to generate meaningful signals, signals that lead to consecutive signals, so buys producing additional buys, sells producing additional sells, and changes in trend are going to be indicative of longer-term movements in price. So if those things are true, we can use a variety of scales to better discern or determine appropriate levels of support. So 4,600 near term on the S&P is a point to watch. The concern or the yellow flag for that matter would be a second consecutive sell on that 20-point, and the fact that we did get a recent flip to negative weekly momentum as well on the S&P. So that very near term 1 week moving average rolling over. That's something to pay close attention to as well. Moving over, another major index that we wanted to talk on today is going to be the Nasdaq Composite, NASD ticker on our system. Looking at a 100-point scale for that chart, we also are reversing up today, intraday up to about 15,800. Keep in mind we're using intraday highs and lows to plot our point figure charts. So with that reversal, we're getting support at about 15.5, which is going to be a positive because before that you were sitting on a pretty big stem. Same case for the S&P 500. We had a big inhale, a pretty sustained rally, sharp exhale, and we're recovering today, which is a positive to put in that near-term level of support. 15.5 on that 100-point chart for the Nasdaq. We want to look at it a little bit shorter. Again, if we want some additional near-term confirmation, if you want to look at the 50-point chart, 15.5 is also an agreement there. So we can use that as well for some near-term support. Beyond that, you're going to have to look closer to about 15,000 flat to get any meaningful level of support, given that we had a big inhale and a pretty big run up before this, Ian. So net positive, you're still in overall positive trends here. Sometimes you'll see those initial sell signals or even initial buy signals if you're selling off to be head fakes. But right now, the most that we can discern is that near-term weakness is looking to be a positive as we're getting some higher levels of support after a pretty big run.
Yeah, absolutely. Well, and I think another pretty important thing that you can kind of note, I mean, we have looked at a lot from a trading perspective, that weekly overbought over sold percentage, right? However bought are these indices, however sold are these indices, or are they trading at relatively normalized trading levels? And especially for the S&P and the Nasdaq, I mean, you can see that both of those went for consecutive weeks beforehand of either 65% overbought or higher. Leading up to last week. And then we flash forward there to last week and we see some these pullbacks leading to levels of around 15 to 20% overbought, which, I mean, it is still technically overbought, but much more normalized from a trading perspective, much less frothy when we're looking at some of these big stems that those are on. Another index, one of the other kind of major indices, the Dow, has also seen some of that similar movement, right? We saw a pretty significant run throughout the course of October and November. Dow, the ticker DJIA on the site, if we look at it on the 150-point box size chart, so like Will said, kind of taking a step back, you want these signals to kind of confirm each other. You want buy signals to lead to further buys, sells to lead to further sells, and so kind of taking a little bit of a step back, that 150-point chart offers some of that perspective, and you can see that big run throughout the kind of late October, early November timeframe. Pullback began a little bit earlier on, but prior to Friday's move for the Dow, back from that all-time chart high of 36 136,450 that we got to earlier this month. And with Friday's move, the Dow was down a little bit over 2.5%, led to actually movement into slightly oversold territory. So we weren't quite as overbought as we were for some of the other more growth-oriented indices, but we got that pullback into slightly oversold territory at a chart level of 34,800 based upon movement through Friday. And then today's move, much like we're seeing for the other indices, reversal back up into a column vex's current chart level of 35,250, offering that near-term support at 34,800. And then you have some pretty tight support levels in there offered as well, kind of from the 34,200 range down to the 33,750. So while further movement lower there, like Will said, this was that, interestingly enough, the only of the major indices that we're kind of looking at here that on this intermediate term scale did not move to a sell signal. So really just seeing it significant stem pull back right around the middle of its trading band. Not a bad looking chart if you kind of squint your eyes and cover up the name, just look at it from a broader perspective there. A name that doesn't look quite as pretty, but not necessarily quite as bad as it may seem from a performance standpoint, was the Russell 2000. So the Russell 2000, as we touched on, was that kind of small cap representative, was beat up the most out of any of these indices that we're touching on this afternoon. Saw some pretty significant underperformance throughout the course of last week, leading to a sell signal on that more intermediate term 20-point chart at 2240. Pushed a little bit further south to 2220 with that movement Friday. Interestingly enough, we're not seeing quite enough kind of improvement on an intraday basis today to lead to a reversal back up into X's. So we're still seeing that chart level at 2220. You do get some reversals up if you look at some shorter term indices, but kind of maintaining that more intermediate term picture for consistency here. You get some pretty notable support levels that are offered from 2200 down to 2120 at the bottom of that respective trading band there. So we saw a breakout from small caps a week or two ago, kind of pushing higher to the upside out of a relatively tight trading band that we've been in throughout much of the past several months, and now pull back right down into oversold territory again here for RUT that you can see there on that 20-point chart. So no shortage of movement throughout most of these domestic equity indices. And one final place that I did want to touch on too, that's an index that we're seeing a lot in the news is crude oil. Obviously, crude oil had a pretty significant run throughout October and their beginning part of November, begin to pull back, and actually with movement there on Friday was down over 10%, looking at CL/, a continuous crude oil contract chart that we have on the platform, down over 10% with movement on Friday, which did lead it to an oversold reading of actually 100% based upon movement there through Friday. So we're seeing a little bit of a rally up for crude at the time of this recording on Monday, but still going to be on 2 consecutive sell signals. I mean, the technical picture of it isn't looking overwhelmingly great at this particular point in time. Kind of seeing a bounce from these heavily oversold conditions that we got to there last week. But nonetheless, crude, when it starts to get going, it tends to get going pretty quickly. So if we start to get a little bit more consistency there, that could be another potential place to monitor. So with that, Will, not sure. I think that wraps up most of what we were looking to touch on here. I mean, a lot of technical heavy content this afternoon, but we wanted to make sure we provided the technical setup there as we're heading into the final month of the year. So with that, yeah, like I said, I think that wraps up the content we were looking to cover here this afternoon. We hope to have you all back next week for our first podcast in the month of December. Look forward to seeing you all next week.